Another big, hugely topical issue for us as general practitioners is the implementation of a local property tax. As recently as yesterday, the Department of Revenue launched a website which we've had a quick look at, and over the days and months ahead, we'll all become more familiar with it. When this half-day conference was announced, it was well known at that time that property tax was going to be coming down the track, and I'd asked Peter Stafford and his client in charge of various to come down and give us a talk. So without further ado, Peter.
Thanks. The property tax, the local property tax as we have to call it, is a very new phenomenon, and it's really a landmark change in property and how property is taxed in Ireland. This is kind of where the property tax regime is today. It was different yesterday, it's going to be different tomorrow, and it's going to be different from here on in. So it does no harm every so often to kind of take stock of where this completely new way of taxing property is coming from and what's likely to happen. Just review the past a bit. So what I wanted to focus on specifically is why we're having a property tax and how is it going to work. Because we get caught up in the minutiae of valuations and the detail of it. But I think if we take a step back, we can see the purpose of the tax, which might just inform us a little bit better about how it's working. I don't know if you can see, but I'm going to focus first on why we've got a property tax. Why is it going to happen? In particular, everything comes back to this chart that I'm going to show now. This is the tax take. This is the money that the government received every year in tax. It informs why we have to have a property tax and why the government's decided to go for it. And you can see kind of the story of the Celtic Tiger in those charts. These are all of the main tax heads that the government gets every year. The blue chart, the blue line at the very top is VAT, followed by the green, which is income tax. And the problem we've had is this is a very pro-cyclical form of tax. That the better the economy does, the more activity is going on in the market, there are more things you can tax, so the government gets more money. The problem is when you have politicians creating the tax system, is the more money they have, the more money they spend. So Charlie McCreevy was kind of the disciple of this. If I have it, I spend it. If I don't, I don't. And when we have a tax regime which looks like this, governments end up with a lot of money sometimes, and no money at other times. The red line is what I'm going to focus on particularly, and that's stamp duty. That's the tax received on the transaction of property. And I kind of want to tell the story of stamp duty, because telling the story of stamp duty tells us why the property tax is coming into being and gives us an idea about what the government's aim is for this tax. So if we look at stamp duty in particular, what I've done here is this is the percentage of tax receipts every year which was accounted for by the transaction of property alone. And you can see in the 1980s, 2-3% of all of the tax received by the government came from property, up to the top of the Celtic Tiger, which was 8%, and fell back down to 2-3%. Stamp duty, governments became very reliant on stamp duty as a form of tax because it involves nothing for them to do. They don't need to do anything, they don't need to create any labour market incentivisation, they just allow the property market to get bigger and faster, and they keep creaming off a percentage of all of the transaction times. So what has happened is, at the top of the market, at 8%, the government and the economy became very exposed to a crash in the market, which is what you can see happened in 2008. And if we focus on this, if you were to design a tax, this pink area here shows exactly what not to do. This is what you don't want to see in any tax regime, because it is based on a high number of transactions and high property prices. And when one of them falls, then the whole thing falls. So what the government has done is recognise that this reliance on transactions is destabilising to the economy and to the exchequer, then they want to move away from it. If we focus on this area a bit more, you can see a fairly straightforward curve. This is the last chart was a picture of the Celtic Tiger. This is a picture of the property crash. What is interesting is if you look at what has happened to house prices, and this is the CSO percentage change every year, and map the two together, you can see that the stamp duty regime was directly linked to property prices. So what the government has done is said, we want to move away from that. We want to move away from our taxes being so exposed to a property market which we now know we cannot control. It's very rare you get a chance to manage to correlate as neatly as that. And luckily I didn't have to give any manipulation of the statistics to get it to work. And it's pretty much the property market and stamp duty is directly linked. If you have an economy which is exposed to stamp duty, that damages an economy in a way that others aren't. The other problem with stamp duty is it's extremely difficult to predict. And this chart here shows the change in percent every year since the 1980s. The government and the economists can't predict what's going to happen to property tax year after year because it's dependent on so many different variables. So the government's aim was to produce a form of property tax which had the benefits which that stamp duty doesn't. And the first thing is predictability. You know how many houses you have, you know that they don't change in price a huge amount over their entire lifetime. If you tax them as a percentage of that value, you can pretty much predict what your income is going to be year after year. The second issue is equality. That people are paying their contribution to the economy not when they buy and sell a house, but even if they don't sell a house. That it's everybody is paying something every year rather than the poor and fortunates who are buying a house at any given time. So the burden of making up that shortfall is shared amongst all 1.9 million houses, not just that number which is sold. And the third is this degree of counter-cyclicality, in the sense that if an economy does very well, then your tax from the value of property doesn't go up that much. But at the same time, if you get a crash in the market, you still get a decent amount of money coming in. So the idea was to stabilise and broaden the tax base. So the next thing is how, and this is where the government has really come unstuck, and this is where we are at the minute. There is no example of international best practice in terms of property tax. There is no model that Ireland could just go to and say, this is how we're going to produce an annual tax. Every country has experimented with taxes. A lot of them have got them right, where they have looked at what is necessary for their economy. They've implemented a scheme which worked well. Other countries have got it disastrously wrong, and we see the riots in Trafalgar Square and the UK government trying to introduce a poll tax. So there are good examples of worst practice, very little example of best practice. So the government signalled back in 2010 of its aim to move away from stamp duty. It said that the tax system must be less cyclical. And so everybody in the property market said, well, the thing that they're talking about is moving away from taxing property at the point of transaction to taxing it on an annualised basis. That's 2010, so you can see it's been a very slow process coming in. The programme for government in 2011 talked about the introduction of a site value tax, where you would pay a tax every year on the value of the site on which the property is built, but not necessarily the value of the property itself. And for a long time it looked as if a site value tax was going to be the format we were going to have. In 2012, the IMF again talked about broadening the base of tax, and they talked for the first time about a value-based property tax. And this was the first signal that, firstly, the government might not be able to get its way in terms of introducing a site value tax, and secondly, it signalled quite clearly that it was the IMF which would be dictating how the property tax worked rather than domestic government. They suggested bringing in a tax of 0.5% on the property market, of property prices, and the world kind of exploded. Enter Kenny said in 2012 that they have certainly rejected the basis of collecting €1 billion per year on the basis of the 0.5% tax. So what did they do? In the budget last year, rather than trying to collect $1 billion in a 0.5%, what they're aiming to do is introduce 500 million. And the aim is to go quite a long way to bridging the shortfall in stamp duty. So this year it's a half year, you only pay tax from July till Christmas. The government hopes to bring in €250 million. And it's not a huge amount in the great scheme of things. 500 million is, and that number is quite low, and that number is only going to get bigger. The second thing is they are binding all property. So all property will be liable for some amount of tax. And the reason they're doing that is because they want to create a database of all property prices. They want to make sure that all properties are brought into the net, even if they're not paying any tax. It's still there. The idea is when that ratchets up over time, all of the property is in place. Thereafter, there are 17 €50,000 bands. This is a fairly complicated way of doing it, but the idea is it's as fair as possible. 17 different categories of property value. You pay a percentage on that. As property prices go up or go down, you move bands, but not a huge amount. The revenue commissioners reckon that 85 to 90% will be in the lowest bands. They claim that such are property prices in Ireland that pretty much 90% of properties will be easily caught within the system. The remaining 10% are much higher, they're individual houses. But they reckon that because 90% of the properties are in 5 of the bands, if there is any variation, it's not particularly massive. So between 100,000 and a million, you're paid at 0.18% of the market value. And for houses above a million, it's 0.25% on the entire value of the property. There will, and then after 2015, each local authority can vary the rate that they charge, the percentage they charge, by plus or minus 15%. And the debate is that strengthens local government, that you're going to have individual local authorities who are saying we are going to provide the following services, and therefore we're going to change the tax to a certain level. So what you might get certain local authorities saying that they're going to privatise certain services and reduce that. Others will say that they're going to provide additional services. It's also an opportunity for local authorities to shape their population. If they want to build up a population of a certain property type, then they'll be able to do so to a certain extent with the property tax. Exemptions apply and deferrals apply, and they're still being worked through at the minute. So where we are at the moment is on the 19th of March, which is next week, Revenue are going to start issuing returns. Revenue are going to write to every single homeowner in the country with an indicative charge. They're going to say, on our basis, your house is worth X on the open market, multiplied by 0.18 means you owe us however much it is. Your job as the homeowner is either to accept that valuation or to self-assess. And what Revenue has said is they want to see as much compliance as possible. They're going to pitch their price, the bill that they send you at such a level that you will be incentivized to do your own valuation, because they're going to overestimate as much as they can. You receive the bill, you'll be shocked at how much they want, so the first thing you're going to do is provide your own valuation. And that's going to happen from the 19th. And you see it on the news this morning and over the next couple of weeks. Those forms are going to be sent out. They set up their database yesterday, which I'm going to talk about in a minute. And that process of self-assessment will go on. Valuation day is the 1st of March. That's the day on which they're making that assumption of what the house, you're making the assumption on what your house is worth on the 1st. The 17th of May is when you submit your hard copy return. You're given until the end of May for electronic returns. And on the 1st of July, if you set up payment at source, the first bill, the first amount of money will be taken out of your bank account. Direct debit begins a fortnight later. Then from the 1st of January 2015, that's when the variation can begin. So there will be a national percentage for the next couple of years. Thereafter, by 15%, each local authority can vary. And then on 1st of November 2016 will be the next round of valuations. And so that cycle of 3-year valuations and an annual change by local authorities will continue after that. This is the form which will be sent out to people. A couple of things to note. The first is the property identification. And this is really key at the whole start of the process. Revenue want to be able to identify every single property, because once the property is valued, then it can be geotagged, they can start to gather more and more information. The idea being, as property tax continues, it's going to become much more nuanced. They're going to be able to follow how property values are changing, you're going to be able to see how properties are changing hands, and for the first time there will be a proper national system of property identifiers which will be centrally coordinated. At the minute there's various different types, this will be centrally coordinated. The second is your liability. This is the self-assessment part. This is where you enter the band number based on the percentage on the value band. And the third part of it is the valuation of the property if it's above €1 million. So that's the easy bit. This next bit is the difficult bit. And this is where we are kind of now. Revenue say that their relationship is between themselves and the taxpayer. They're going to send you the form and they say they've made it as easy as possible. You will receive the bill from them, you will write in your own band, your own valuation, based on your knowledge of your house. Or if there is something complicated about your house, then you engage a valuer to do it for you. But that's up to you. They don't care, Revenue don't care about any third party. They don't care if you select a valuer with all of the qualifications, or if you decide to get your mate who knows a bit about houses to value your property, as long as it stands up to scrutiny. If they decide to go after you as the taxpayer, they're going after you. You as the taxpayer then go after the valuer. So they haven't given any great direction about how a valuer goes about valuing the property. As far as they're concerned, their responsibility ends with the form out to the taxpayer. It's the role of the society, the role of others, to provide guidance to valuers to ensure that they adhere to best practice. Revenue want to be able to question and appeal every valuation which comes back to them. So they don't want to limit themselves by approving certain people to do valuations. Their relationship, as I said, is with the taxpayer themselves. So I suppose the definition that they're using, and this is where their responsibility ends and the responsibility of the professional body begins, is that that's their definition of what a residential property is. And it's pretty clear for 95% of properties how that's going to work. There will be those which are unusual, they're farmhouses or there's granny flats attached to them, and that's where the professional services of a valuer is going to come in. They're trying to make it as easy as possible for people to value their property. And the first thing they're going to have produced last night is a Revenue Online Property Valuation Guidance, which is effectively a map of the country with the different regional prices put in. They're using information from stamp duty, they're using information from the property price database. That's your first port of call. That will give you the bands in which your area is situated. It's your responsibility, in the knowledge of your property, to decide whether that's the right value. It might mean that you know that your house is slightly smaller than others, that it isn't in such good condition, it has fewer bedrooms, fewer bathrooms. That's your responsibility to round down. If your property is bigger and better and much more exclusive than others, it's your responsibility to round up. That's your responsibility. And if you get it wrong, Revenue are coming after you. So it's a guide. The second source of information is the National Residential Property Price Database. And Revenue are saying that as more properties get sold, more properties are going to appear on the database. So the minute the properties which appear there go back to being sold in 2010, their aim is, as it goes, there'll be much better information to use. And the third, and again, this is as far as Revenue have gone, you may choose to obtain a valuation from a competent professional valuer. They're not defining what that is. That's up to you as the homeowner to decide whether the person you're getting a valuation from is competent and professional. It's also a warning to people who are putting themselves out there as offering valuation services for homeowners, and in doing so they are saying that they are competent and professional. So what they're looking for at the moment, I think 2013 to 2015 is a transitionary period. They're looking for compliance rather than accuracy. They're looking for everybody who receives the form to do a self-assessment and get their property value into a €50,000 band. They're not looking for it to be completely accurate because they know that that information just doesn't exist. What they're looking for is people to fill in the form and send it back to them, so that as the property tax moves on, the degree of accuracy gets closer and closer. So they're going to be doing a carrot and stick approach. The stick is, you need to value your property. But the carrot is, if you are wrong, we'll kind of forgive you if you can justify to us how you came up with that valuation. They're not going to start throwing people in jail for getting their property values wrong by 50 grand. They're just looking for compliance. So there's a few issues which are coming out, and the last point I think is key there, that if you follow the guidelines, honestly, they'll accept the valuation, accept your assessment and the evaluation will not be challenged. I'd imagine over time, that kind of carrot will disappear and a harder regime will come in. But at the minute, what they're looking for is houses to be valued. So the issue really, and this is where we are at the minute, we're in this period between Revenue having made those statements and the society then producing guidelines for its members. And At the minute, my colleagues and the valuers are putting together the guidance note to take over that space where revenue responsibility stops and professional bodies responsibility begins. So where we are, there's a few kind of key issues, a few teething issues. The first is the issue between the debate between chargeable value and market value. Again, no massive difference, but revenue are talking about unencumbered fee simples and so on. And it's language which we need to get clear from a valuer's guidelines. The second is guidance on outbuildings. When we went to meet revenue, when we discussed these things, they said they didn't really hadn't thought about it, but we're going to get back to us. We're ignoring title defects and they're assuming easements. What they're assuming is that the property is being lived in, can be lived in, and has a certain value. But those kind of issues, they're the kind of the 10% properties which don't fall neatly into the first 5 categories. Revenue's guidance to charter surveyors is that they must adhere to best practice and that the valuation will stand up to scrutiny and appeal. And it's okay for somebody who is doing a self-assessment to honestly assess their value, but get it wrong if there isn't a defence of honest belief. If I honestly believe that's what my house is worth, you'll do it. But if you're engaging a valuer, then the standard of care is higher. That you are putting yourself out there as knowing more about it. So if you provide a valuation to a homeowner, then it has to stand up to a scrutiny appeal, and you need to show that you've adhered to best practice, and we'll be issuing guidance on what that looks like. But those are kind of new. The third part of it is because revenue only have a relationship with the taxpayer rather than any third party, the exact methodology of the valuation by valuers is really of little concern to them. But what they have said is there's really 3 forms of valuation. One is the desktop valuation. If you as the agent have recently sold the property, it's on your files, you're very familiar with the specific property, a desktop valuation will suffice as long as it stands up to best practice. Second is if you have recently sold the property, but you need to do a drive-by valuation to refresh your mind, again, that will suffice. However, complicated properties or ones where you don't know about it will require a site visit. Revenue are concerned that every property is valued. They don't want to see a whole string of valuations which come from properties on one street as in a list model, like they have apparently in the north. What they're interested in is individual properties. So you as the self-assessor or you as the valuer will need to show that you have valued that specific property to the best practice rather than one like it. So that's kind of where we are. What happens next is that Revenue Online property valuation guidance website is live, it's up and running. I don't find it very easy to use. I think there are going to be a lot of people who don't find it very easy to use. What they have said is that the property price register is there. My home website is Daft will certainly be providing their data to assist people as well. We'll have to see how that goes. It might be that organisations such as ourselves provide additional help for people to use that website. We'll be producing a guidance note fairly soon for members on how to adhere to best practice. We're going to be organising a CPD event in the next couple of weeks with the Revenue Commissioners. And they will be taking questions from valuers from their perspective of what they're looking for, and we'll be engaging. As Kira said this morning, we'll be doing further public seminars, hopefully with the Irish Taxation Institute. So if we can provide a CPD event to give our members additional knowledge, we'll see if we can do the same for the public. Bearing in mind, we're in a very new period, and Revenue are certainly sort of not making it up as they go along, but their issue is that they're looking for as much compliance rather than as much accuracy. If anybody has any experience of either dealing with Revenue or dealing with homeowners who are looking for valuations, anything which isn't easy, we have an open door with Revenue. They will take all of the questions that we have either through our CPD events or through the public seminar, because they are trying to provide a constant update to help people as far as possible. Their aim is to make it as easy as possible and to ensure 100% compliance rather than accuracy, and we'll feed back through them. So that's kind of where we were at the end of Morning Ireland this morning. Whether the debates moved on any further, I don't know, But certainly we'll be providing information both ways. So that's all there.
Thank you, Peter. A couple of quick questions if we have a couple of minutes. You clearly met revenue, Peter. In terms of situation, I think they've already flagged this. If you self-assess at whatever the case may be, 500,000, and you subsequently come to sell the property at a substantially higher figure, they're going to be coming back to the homeowner or property owner to presumably pay the whatever is due in terms of additional tax on the higher value.
Yeah, there's an appeals process. So what will happen is, say you did exactly that and you sold within quite a short period of time of making that assessment, you would then go to the appeals commissioner with your reason about why you valued it at that point and why your house is now subsequently worth more. They will have their own panel of valuation experts who will be saying the contrary, and you effectively battle it out in front of the commissioner. But their defence, your defence of honest belief is one which will be very persuasive in the short term. So if you say, look, I have a house which is very, very difficult to value because it's different to all of the others. I bought it for X amount. I honestly thought it was worth about 500,000. However, we've got very, very good competition amongst some potential purchasers which push the price up to more than I expected. Then there is a degree of leniency. But if it looks as if you have massively underestimated for the purposes of defrauding revenue, then we'll make up the shortfall.
One assumes it worked the other way if you over-assess and you subsequently sell a property. I don't know where we'll go. Do you get a check in the books? Yeah. Final question. These are clearly taxes raised naturally but for use at the local level, and sort of endorsing it, most of us recognise we need to broaden the tax base and it's more equitable long-term use of tax policy. Have they given you any guidance in terms of any transparency surrounding ring fencing of the revenue that's going to be generated in terms of being utilised at a local level?
No, very little. So all of the property is going to be gathered centrally then redistributed. So that's why local authorities are being taxed on the property that they own, even though theoretically the money goes back to them. What they want to do is, because they want every property to be paying something, it's being collected centrally and redistributed. At the moment how that works, we don't know. What is likely to happen from 2015 when each local authority has the power of valuation, then there'll be a burden on them to show why they're raising the money and what they're raising the money for. Certainly from what the society's been doing, we've been looking for the maximum transparency. So the ideal would be, in due course, you get your bill not from revenue but from the local authority, and on the back of the form is your local property tax this year is €500. This is how it's being spent. So you're 25 quid on fire services, 100 quid on this, 100 quid on that, and that's the maximum transparency. That's the ultimate point. It looks as if there's going to be a bit of redistribution going on. The other thing we were looking for, and again it might happen yet because we're in this kind of interim period, is rather than 100% of all of the money going back to the local authority, 80% of it does, 20% is kind of pooled at a regional level to facilitate, to fund regional infrastructure. So if you have an urban area, a city with a lower population hinterland, then rather than the city getting all of the money, the rural area getting nothing, it's redistributed so that money is taken to support regional infrastructure. All we know is effectively what's in the finance bill, which is that it's collected by revenue and it will be redistributed through the Department of Environment. But the more transparency we can have without distorting the market too much, the better. So that's where we are.
Peter, you know, if you're doing a self-assessment for yourself or a client or whatever, do you have to put an explanatory, paragraph in as to why you feel the value is X, or do you just fill in a box with the value and if they come back to you, they come back to you? Or?
Yeah, that's kind of where we are at the minute. Is if you were to ask revenue, their answer is no.
Okay.
But they're saying at the same time your valuation has to stand up to scrutiny and appeal, which from our valuers, like our valuation professional group in society, are saying, therefore you kind of need to do that.
Yeah.
So what we're putting together is a template where you will put in a description of the property, right, put in a photo, its location, its size, all the rest of it, and then the assumptions that you've made, which has led to that valuation. And it just means that if you get to that appeals process, your client is able to show a proper
It's a
valuation.
backup as such.
Yeah.
And is there a plan to, and I know it's going to see as we go for the next few years, is there a plan to query every self-assessment?
No, what they'll do is they'll gather,
Pick and choose?
well, it's usually the point of sale. So they'll have their database set up and running. They'll put the transaction through the database, and if it's out by whatever percent, it'll ring a bell. And this is, again, something which has worked really well in Canada, where they introduced something similar for preventing fraud, so that they put all transactions through the property price database, which meant that if a house was selling, if a house was moving hands often, it would raise an alarm. If it suddenly was being sold for pennies and then was being sold for millions, they can look at the historical transactions and link it back to what should be the assumption. So I think, no, from most properties will be fine. It's those which are raising their alarm that start to scrutinise.
And actually, sorry, one more question. Are they taking everything off its source, or do you have the opportunity to pay to your local authority or region, and then if you don't within a certain period, it gets taken off its source, or is it automatically taken off its source?
No, you can choose how you do it.
Oh, you can choose.
So you can pay in cash in the post office on a weekly basis if you want. They really got their fingers burnt with the household charge.
Yeah, that's what I was
So in fact, you can even pay in like Centra and Spa and places like the bill pay, you know, where
Yeah.
people pay their bills. You can do the same there. But what they said is if you don't pay within a certain period, because they're revenue, they have the ability to take it at source. But when we met them again, they said if in an issue of weeks, it looks as if people are complaining that they can't pay in a certain way, they would be open to doing that. So like one idea they had was you can even go to your local revenue commissioner's office and pay. You know, they're really trying to make it as easy as possible. Again, it's carrot and stick. Make it as easy as possible, so if you don't do it, the burden is then on you to prove why.
Sorry, just one thing, this might be a bit sort of fuzzy. If I do a self-assessment on my own house, as a chartered surveyor, am I subject to the householders' requirements or the valuers' requirements? Are they going to come out, have you got because of your qualification, how are they going to treat you doing your own self-assessment?
Same as everybody, except in the appeal line, so if you
Yeah, so
find
just
that
checking,
more
just checking the
appeal,
reason.
I would imagine that if I was the commissioner, I might be questioning you a bit more than I would.
It's back to that honest belief
Mm.
thing. And so what again, you read between the lines about where the carrot and stick. The idea is the little old lady gets it wrong, don't give her the benefit of the doubt. But if and they look at your job and they say, you did not honestly believe that your house was worth X because you are professionally valuing property. So on the one hand it's unfair, but on the other hand you can't raise that defence.
Yeah, the issue, like for me personally, if I was on my personal property, I would look for it to be valued from the point of view that if that valuation was wrong, I would be looking for something to sue. So I'd be going, if I get hit with penalties in 10 years' time or 5 years' time because I'm subject to an audit, it's exactly, I'd be going after a PI cover to cover the costs, whatever penalties the revenue are going to put on me. So the question there is, are you going to sue yourself? Are you in the personal capacity, or are you in your capacity of a chartered surveyor in that situation? You're in your personal capacity.
That's just if very useful to come back to your house. That's as you said, like the householders, like the honest belief, and you put down the honest belief, but as your job, are they going to be more liable to come looking at your honest belief?
And that's,
as opposed, and
but that's where I would have to caution, and that's where the real issue is my next door neighbour, I'm a chartered valuation surveyor, my next door neighbour asks me as a favour, will you sign one letter, value is whatever, and I do it in good faith. Yes, your PI is at risk there. That's the real issue. Is to me, I address all these questions as your PI.
And we've had some people suggesting that they were going to do it free of charge as a service to promote their brand and their neighbourhood. Yeah, and that's fine, but as long as those people who were doing that realise that ultimately, if they're certainly the members of the society, they'd be needing to adhere broadly to the best practice guideline that's there, and ultimately comes back to their PI.
And that is the issue. I mean, the example always of the 80-year-old it isn't the issue of the 80-year-old, it'll be the 80-year-old siblings when the transaction comes to liquidate that estate, and they realise that, you know, somebody has advised them that the property values this, and all of a sudden, I mean, we see them all the time, tax defaulter lists, you know, the original default on tax is always a minor percentage compared to the penalties and interests that go up and down. So that's where the interest is the riskier PI cover. I think, sorry, can I just make one other point? For you personally, I think the fact you open yourself up into, I think this is an extreme example, but you open yourself up to professional complaint from the revenue of misconduct in your personal property, if you know what I mean.
The other thing that form, you only have to fill in the actual figure if it's over $1 million, is that right?
Yeah.
So you just put the band in.
That's right.
So, say you think the house is worth 120, 130, you don't have to say that, you just have to say it's in band B, presumably.
Yeah, so on the back of the form are the band categories. So if you're saying 130 or whatever.
Whatever, yeah. So it's within that band.
So you're in the band 3, I think, which is 100 to 150. So that's all you're doing, and then you work out 0.18% of the midpoint of that. But they'll do that for you.
And are they going to send out just saying your property's in band 3? They're not going to give you an exact figure?
No, that's right. And it's an estimate as well. So they're doing a very rough and ready calculation. So they'll look at their database that they have, they'll look at your house, they'll say it's 130, so they'll round up to the next band 2 to say in fact we're valuing it at 250, so that you're incentivized then to get a proper valuation done.
Even though on their website they're showing where the band should be,
they'll round
up it.
Yeah.
And they're being quite clever as well. All the stuff I've seen in the video is reference to the suggested band is going to be guidance. And guidance is the lowest form of, for example, even the SCSI guidance note here is not a mandatory practice standard. There's a huge difference between those two aspects. And the revenue keep, every time I hear band, it is always, and we will give people guidance. And I have previous experience from our CT tax where revenue come out and you say, but there was the guidance, and they go, yeah, but we've now interpreted the law as this. And you're saying, but there's your guidance, and they're going, yeah, but we've now finally figured out what the law actually meant at that time. And that's when they...
So yeah, if a model is with certain groups of self-employed people, but they send out an indicative tax bill, and the idea is you want to pay the bill by sending you get your accounts audited, and you do it properly.
I think, Peter, my sense of it is, they have a nail on the head when you said they're within 1.7, 1.8 million houses to assess the level of compliance for the first couple of years. I think valuation would be a separate issue. And we come down to that.
They're going to risk model it. They're going to punch it into the data, and they're going to be able to see patterns.
Yeah.
And that's where it's going. And they'll actually get the software to identify when the pattern is broken. And that's what
And at the minute you can't do that because not every property is on the same database. So that's why there's the zero rating of tax is to make sure it's in the net so that they can add that, they can geotag all of the properties.
And as market conditions improve, there'll be more transactional activity and to build a picture. So it could be 4 or 5 years' time before we have more accurate view of values. And this is initially it'll be compliance based.
Exactly. The revenue was saying this is, it goes back to my starting point, which is they're trying to create a property tax regime which can survive a recession as well as a property boom. So this is something for the long haul. This is not a stamp duty which is going to get tinkered with at every budget day. This is going to be, you're going to be paying tax annually on your property for every year. So they have a couple of years of getting the system up and running.
Where are they getting their property lists from? Is it the local authorities are providing them, or the actual properties themselves?
Well, from the stamp duty.
Stamp duty.
And then you have another model which is being put on that. The economist who's putting it together, speaking at our CBD event, so he'll talk more about how they've created.
And there's on the thing, there's a whole, it's a 10-page document by Keith Walsh, who's the economist, that put it together, and you can read his document, and you would be interested in that more so that it's a hard read for a consumer, but it goes through all of that, where they constructed the data, how they put it together, the various sources that they use.
I think that's a good thing about revenue doing it, is they have the power to gather a lot of data.
Questions? Yeah. A sincere word of thanks to Peter, Brian, and indeed Ciara for coming down this afternoon. We're all getting going a little bit early. Quick reminder: our AGM is coming up on the 24th of April, and hopefully see
see everybody there.
Thank you.
Sure.